All right, let's get into it. We're talking about Rexford Industrial, ticker REXR. And this is a fascinating story, really. You have this real estate juggernaut, a company that absolutely dominated the tightest industrial market in the world, Southern California. But now? Well, now they're staring down a fundamental crisis in their business model. Let's dig in.
So this quote right here, it nails the whole dilemma perfectly. You see, Rexford had this beautifully simple, incredibly powerful, and frankly, wildly profitable growth algorithm. I mean, this is what made them a darling on Wall Street. And now, it's just broken. The math just doesn't pencil out anymore.
I mean, for almost a decade, their playbook was just brilliant. So simple. They'd go out, buy these kind of tired, undermanaged industrial buildings in prime Southern California spots, sink some capital into them to bring them up to modern standards, and then boom, release them at way, way higher rents. It was literally a money-printing machine. But that machine, it's completely seized up.
Okay, so before we dive into all the problems, it is absolutely critical to understand the quality of the real estate they actually own. Because Rexford's portfolio, it's a genuine fortress. We're talking about a competitive moat here that is just about impossible for anyone else to replicate. All right, so what's so powerful here is how these three layers just compound on each other. First, you've got the simple geography of the place. You're basically on an island of industrial land, hemmed in by the Pacific on one side and mountains on the other. You can't just make more land. Second, there's the economics of drayage. That's the short-haul trucking from the ports to the warehouses. Tenants will pay insane rent premiums to be close to the action because, let's face it, rent is a tiny slice of their total logistics pie compared to what they spend on transportation. And then the third layer, California's famous red tape. It's a massive headache to operate in for sure, but it also acts as its incredible barrier to entry. It just strangles new supply, which is fantastic if you're an incumbent like Rexford.
And this number right here, this is the proof in the pudding. It just perfectly illustrates the power of that moat. Think about it. Even with the market softening up, Rexford's occupancy is sitting at a rock-solid 96.8%. That tells you these buildings are absolutely mission-critical for the companies that lease them.
Okay, so let's get to the heart of the matter. You've got this fortress of assets, right? But the financial engine that was built to monetize that fortress is completely stalled out. And this is really where the whole story shifts. We're moving away from a simple growth narrative to something entirely different.
The big villain in this story is something called negative leverage. And here's how it works. For years, REXR could issue stock and debt to go out and buy properties yielding, let's say, 3.5%. Easy. But now, their cost of capital has shot up. It's pushing 6%. So buying that same asset is now immediately dilutive to their earnings. It's a losing proposition from day one. That massive acquisition machine of theirs, we're talking $1.5 billion in deals last year, it has just ground to a total halt.
Now, if you're a REIT investor, you know this is the metric that matters more than anything. Leasing spreads. It's simply the change in rent between a new lease and the old one. It is the best leading indicator you have for future organic growth. And for Rexford, well, the trend here is frankly pretty alarming.
So let's just set a baseline here so we all know what we're talking about. If you rewind to the peak, the total market euphoria of 2022, Rexford was putting up cash leasing spreads of 60, 70, even 80%. They were practically doubling the rent on some of these expiring leases. It was an incredible time.
Okay, now fast forward. Look at this compression. By Q3 of 2025, that same cash leasing spread had collapsed all the way down to just 10.3%. Now, okay, it's still positive, but that is a violent deceleration. It's a huge red flag that signals a massive loss of pricing power.
And then there's this. This is the number that has the market absolutely terrified. Management let it slip that they had a recent negative 1% cash mark to market. What does that mean? It means that right now, for some of their buildings, market rents are actually lower than the rents on the leases that are about to expire. If that trend picks up steam, the whole organic growth story just evaporates. Poof!
And it's not just acquisitions. Their other growth engine, redevelopment, is sputtering too. What used to be a reliable 6 to 7% yield machine is now spitting out a pretty meager 4.4%. And let's be honest, in this interest rate environment, that kind of return just does not justify the risk involved.
So, the old playbook is in the trash. It's broken. The company had no choice but to find a new one. And this really marks a huge strategic pivot for them, away from what you might call mindless growth and empire building, and toward a much more disciplined focus on creating per-share value.
And, it's worth noting this pivot wasn't exactly voluntary.
The catalyst here was the arrival of a well-known activist investor, Elliott Investment Management. They showed up and basically forced the board's hand, making them ditch that growth-at-any-cost mentality for a strategy that actually benefits the people who already own the stock.
And this right here, this captures the new strategy perfectly. It's a simple, almost elegant arbitrage. Think about it. Management is selling their physical buildings in the private market where they're getting really expensive valuations. We're talking a low 4.2% cap rate. Then they take that cash and turn around and buy back their own stock, which the public market is pricing much more cheaply, at about a 5.8% implied cap. Selling high and buying low. It is just textbook value creation.
And to make sure this new playbook actually works, there's been a big change in leadership. The founders are out. The incoming CEO, Laura Clark, comes from a CFO background and is seen as a really disciplined operator. So the focus is now on things like cutting corporate bloat and, this is the big one, tying executive pay to per-share metrics, not just on how big the empire gets.
All right, so this brings us to the investor's calculus, right? This is the bottom line. You've got this super high-quality portfolio, but it's facing some very real headwinds. At the same time, you've got a new shareholder-friendly game plan in place. So how does all that shake out when you look at valuation and risk?
Well, looking at the numbers, at around 17 times 2025 FFO, you can see the stock is definitely not priced for aggressive growth anymore. But the really key metric here, as you know, is the discount to NAV. The stock is trading for about 20% less than what you could sell the actual real estate for in the private market, and that provides a pretty significant margin of safety.
And you can see that discount really clearly when you stack it up against its high-quality peers. REXR used to trade at a premium to guys like Prologis and East Group. Now, it's at a material discount. So the market is without a doubt pricing in the specific risks of being in Southern California right now, and of course that decelerating growth we've been talking about.
And look, let's not downplay those risks. They are substantial. You've got these uniquely Californian regulations like the Measure ULA transfer tax that's just gumming up the works for transactions and new programs that add costs for tenants. But the biggest, most immediate threat is still that continued erosion of market rents. And then, kind of looming over all of it, is the macro picture. What if new U.S. tariffs hit import volumes at the ports? That would directly impact demand for Rexford's warehouses.
So, here's the key takeaway. The investment case has completely changed. You're not buying Rexford anymore for explosive rental growth. That ship has sailed, at least for now. You're buying this as a value play. It's a bet that this new management team can actually pull off this arbitrage, selling high, buying low, all while navigating what is a genuinely tough market. And honestly, their greatest weapon in this fight is their balance sheet. It's an absolute fortress. We're talking net debt to EBITDA of just 4.1x, and they're sitting on $1.6 billion in liquidity. What that means is they have immense flexibility. They are not a forced seller of assets, and they've got plenty of firepower to keep buying back their own stock whenever they see an opportunity.
But in the end, it really all boils down to one critical question. The true value of this fortress portfolio and the brilliance of this new capital allocation plan, it's all going to be put to the test when that big wave of leases comes up for renewal in 2026 and 2027. So, the question is, will management be signing new leases at higher rents? Or will they be forced to give back all the incredible gains from the last few years? The answer to that single question, well, that's what will determine the future of Rexford Industrial.